VA loan. This is a 0% down loan that is offered by the Department of Veteran Affairs. You will have to pay closing costs and a funding fee, but you can put these into the loan to make it a true $0 down loan. You can buy a 1 to 4 unit property. You need to live in it for 1 year. This is for people who are active duty service members, veterans, National Guard, or a spouse of a member who died. And you typically need a 620 FICO score, even though the VA doesn't set one. VA Native American Direct Loan. This is a special VA loan if you're a Native American veteran who wants to buy on federal trust land. USDA Single Family Guaranteed. This is a 0% down loan from the U.S. Department of Agriculture. There's an upfront fee that you'll have to get into the loan and closing costs covered by the seller. To qualify, your adjusted income must not exceed 115% of the area's median income for households of 1 to 4 people, or 150% if you have 5 to 8 people. There's no hard FICO minimum, but it's usually around 640. You need all your debts to be less than 41% of your income, 2 years of income, be a U.S. citizen, and it needs to be in a USDA eligible area. Think of outside of the cities. There's an eligibility map you can find online, and can only be used on your primary residence, single family, or condo. USDA Section 502 Direct. This is the same as the last one, but it is aimed at very low to low income applicants with adjusted income of 50 to 80% of AMI. Some of these loans can be 33 to even 38 years in length, lowering your payment, and it includes payment assistance for the houses. NACA Purchase Program. This is a 0% down loan with the Neighborhood Assistance Corporation of America. It has no closing costs, no fees, and no mortgage insurance. You just need to have enough money for 6 months of the mortgage payments in your bank account, but those can come from gifts. You need to attend workshops and work with the NACA counselor. You pay $36 a year to be in the program, and you need to live in the property for the life of the loan, and the only way to turn it to a rental property would be to refinance. Navy Federal Home Buyer's Choice. This is a 0% down loan offered by Navy Federal Credit Union, meant for military-affiliated buyers. If you get the seller to pay your closing costs, you will make it $0 down. Very similar to the VA loan, but it is backed by Navy Federal. Physician mortgages. These are 0% down loans up to $1 million for doctors, dentists, and similar professions. They waive PMI and consider future income. There's a funding fee that you can wrap into the loan, and if you combine that with seller-paid closing costs, it'll be $0 down. You typically need 700 plus FICO score, and it's for primary properties only. Local bank / community 0% down pilots. These are special programs with 0% down mortgages in different areas across the country with different banks. Each one will have different options. You will have PMI every single month. Usually they have less than 45% debt to income, 600 FICO minimums, and it's usually meant for first-time home buyers. You can't own any other property, and they have income limits of 80 to 115% of the area's median income. Some places that have this are Flagstar Destination, Bank of America, and FHL Bank Chicago. FHA 203H Disaster Victim. This is a 0% down loan meant for people whose house, either one that they owned or rented, was destroyed or damaged to make it uninhabitable. FICO score as low as 500, and your debt to income needs to be 43% or less with 2 years of income. You need to register with FEMA, and this works on single family homes or condos. Getting gift funds from family, employer, nonprofit, with FHA or conventional. This isn't a loan, but a method to lower a down payment on a loan. You can get a gift of money from a family member, employers, or nonprofits that can cover up to 100% of the down payment on a house on FHA or conventional loans that's for personal residence. Seller concessions / credits to cover closing costs. This is not a loan, but instead a way to lower how much you need to close on a property. The amount will vary by what loan you use, but these are funds from the seller that cover your closing costs when you buy the house. Sometimes sellers pay this outright, or you pay it over time via the loan. If it's the second way, then you must make sure that the house is worth what you're buying it for, plus the closing cost amount. Down payment assistance. These are either grants, forgivable loans, or second mortgages given by governments, nonprofits, or lenders to cover down payments and closing costs if you meet certain criteria. Grants don't need to get paid back. Forgivable loans are loans that are wiped away after you meet certain requirements. There are 2,554 programs that exist for this nationwide. These are meant for first-time home buyers that are lower / median income. You can find some at downpaymentresource.com. Lender credits. This is not a loan, but incentives from a mortgage lender to get you to reduce your closing costs in exchange for a higher interest rate on your loan. Usually for every 1% covered of the house price, your rate increases 0.25%. Check with the lender that you're looking for if they offer this. Borrowed funds secured by financial assets to cover down payments. This is when you use other assets that you have, like a car, art, or others to borrow against that and use that money you get from that loan to pay for the house. A few types of these are HELOC. This is a line of credit that you get on the house you own. You use this money to buy a property cash or use it to cover the down payment. Cash out refinances. This is a loan you get on the house you own and use the funds to cover the down payment and buy a property cash. The difference between this and HELOCs are lines of credit that you can use over and over again, and usually the rate is variable. Cash out refinances, all the cash comes out at once, and the rate is usually fixed. 401k loans. This is when you borrow from your 401k up to 50k or 50%, whichever is less, for a primary home down payment. You pay it back in 5 years, and then you pay no penalties. You can use that money for the down payment or cash on a house. Roth IRA/IRA funds. You can use up to $10,000 penalty-free from your IRA to buy a house you're going to live in. If your down payment is less than $10,000, your whole down payment is covered. SBLOCs. This is a securities-backed line of credit or loan. You take out money against your stocks and use that for down payment or cash for the house. 0% credit card. These are credit cards that are 0% interest, usually for 12 months. You typically need a 700 plus credit score for them and a business for at least 2 years. You get the card, you do a cash advance and pay the fee, which is usually 3%. Then you take that and you buy a house, cash, and cover the down payment. After 12 months, when your interest kicks in, you fix and flip the property so this way you pay off the credit card. If combining with the loan, you need to pull the money off the card for 2 months before you get the loan so the funds settle. Business credit lines. Similar to the credit card, this is a line of credit based on the business you have. You can take the funds 2 months early if you need them for the down payment, or take it and buy a property cash, but you're facing interest right away. Life insurance policy loan. This is a loan you take out against the cash value for the down payment or buying a property cash. Your life insurance policy grows while the money is used to buy real estate. Self-directed IRAs. You can use the money in your self-directed IRA to buy real estate 100%. The money you make with that property is tax deferred. Seller financing. This is when you get a mortgage with the person who owns the house. Because they don't have set terms, you can negotiate putting 0% down in exchange for higher rates or something else. Seller financing second mortgage. This is when the seller of the house gives you a mortgage for your down payment gap, while another lender gives you the rest. Wraparound mortgage. You buy a house with someone who already has a mortgage. You create a new wrap mortgage with the seller for the loan amount. You need a promissory note and a deed of trust, and you need to make sure you protect yourself because the previous mortgage company can trigger what's known as a due on sale clause, which makes you pay the house in full immediately. You make payments to the mortgage for them. Usually it ends up being just subject to. This is when you buy a property by taking over the current owner's mortgage. This can trigger the due on sale clause too, so watch out. Real estate crowdfunding. This is when you use an online platform with a property you want to buy and pool your money together with other people. You offer to come in doing the work in exchange for a percentage of ownership in the property. Equity partner. This is when you partner with one or more people you know who bring the money to invest and you do the work. You split the profits and you buy properties with none of your own money. Private money loans. This is when you get a loan from a person you know. They're flexible and can offer 0% down depending on your relationship, your experience, and the deal. These are high interest, short-term loans used to fix and flip properties. Hard money loans. This is like a private money loan but through a company. Usually they require some down payment, but some might allow you to avoid down payment if you have a great deal and experience. Syndication, and you're the GP. A syndication is a way to buy real estate using other people's money. You find investors to fund the entire purchase and manage the property. This is usually used for large commercial properties and has lots of investors and lots of legal complexities. SBA loans. These are loans for commercial real estate that allow you to buy places you will use for your business. 7A SBA loan will give you up to 85% down, and then if you combine that with seller concessions and seller financing, you can get the rest. 504 loans will be 50% bank loan, 40% SBA loan, and 10% seller finance. Piggyback loans. This allows you to get a loan with multiple mortgages. You will get one mortgage that is 80% of the price, then either another one that is 20% or two more that are 10% each. This is great because it allows you to avoid PMI while also putting low money down. This is usually for people who have great credit and stable income. You just need to find a bank that allows it. If you enjoyed this video, watch the next one on screen.